Hello viewers, so today is 2nd of June 2026 and I like to cover the budget came on 28th of May on 2026, and what I want to cover only the text topics because the budget is quite big. We can't cover the whole thing and there are many scholars and professionals out there and they know more than me. So I like to cover only the taxation part, and in taxation part only few things that's going to affect the small businesses who I advise to, and small businesses where I specialize into. So one of the major thing that's going to be company loans to shareholder. Now recently IRD did put the proposal forward where they wanted to make these changes, and they put it out there that all those shareholder current account where they have a debit balances that will be affected. However, that change is not going to go ahead. I also made a video on that, so perhaps that video is no longer applicable because they have backtracked themselves and they have come up with this new proposal. And this, according to this new proposal, what they're saying is the issue in one sentence. That's what they're saying. A company lends money to a shareholder. This can be a formal loan, drawings, and overdrawn current account. So if the company is removed from the register, so the main word is here, removed from the register. If it's removed from the register, under the proposal, if the loan is still unpaid, the amount can become taxable income to the borrower 6 months later. So what it means is, if you withdraw money from the company, and let's say you've been withdrawing the money and you currently owe $100,000 back to the company, you're running the business, all of a sudden, no problem, right? But all of a sudden, if you struck this company off and this is removed from the company's register, removal can be done through business cessation. The business is no longer operating. A removal can be done via liquidation. If these things are happening within 6 months, this will become income. So this is what they have done, and why they're doing it. This is mainly about timing enforcement. Inland Revenue wants the tax position dealt with before the company disappear from practical view. So this is mainly what they're trying to do. So what's been happening, what they say is, why the government say this is needed? This is the main thing. Many closed companies are removed while shareholders' loans or debit current accounts remains unpaid. So current law does not have specific rule that clearly taxes the outstanding loan at deregistration. The timing of income can unclear and may arise years later, if at all. Once a company is removed, Inland Revenue says monitoring and assessment becomes very difficult. So this is the main thing here. Integrity concern: if a borrower keeps the company money and the company is removed from the loan, may never be repaid and no tax will be collected. See the problem, can you see? Once the company is removed, Inland Revenue always lose this money. So what they are saying is, before it's removed, it becomes income in the hand of recipient. So in quickly 4 steps, what is proposed? 1, 2, 3, 4. Step number 1, borrower is connected, whether it's a director, close relative, shareholder, director, anyone. We can't muck around. Second things, is this unpaid on the outstanding date? Yes. Third thing, 6 months trigger. 6 months after removal, remaining payments are treated as discharge in the hands of the person who owes the money to the company. It becomes a taxable income. A base price adjustment is calculated and may create taxable income for the borrower. So that's the main thing. The 6 months timeline is, this is very important. Day 0, company is removed. Grace period allows time to reinstate a company removed by mistake. Like sometimes it does happen that company is removed by mistake. If it does, we give you 6 months to fix it. Okay, if it's all done, month 6, tax trigger. If not, removal is not restored, then remaining amount is treated discharged at base price adjustment applies. Important point, 4 December 2025. So that's the application date, because what they have done, the date they announced, they backtracked 6 months back. So what they are saying, any company is removed on or after 4th of December 2025, this 6 months grace period will apply. Within that, if it's not repaid, this is the tax trigger will come, and this will become income in the hands of the recipient. So who are the people who can be caught under this? Shareholders can be caught under this, directors can be caught under that, and close relatives will also come under this net. Example is companies removed on 10th of January 2026. Shareholder current account debit is $120,000. No repayment or reinstatement within 6 months. Okay. On 10 July 2026, the outstanding balance is treated as discharge. The borrower calculates a base price, and this 120,000 becomes that someone's income. It's as simple as that. More likely affected, all those closed companies, shareholders, directors, overdrawn current account, loans not cleared before the deregistration. These people will be affected. Who's not affected? Loans repaid before removal, companies reinstated within 6 months, widely held companies in ordinary circumstances, partnership and sole traders are outside of this. So basically, this is in a nutshell. To summarize, if company is removed and you do have overdrawn shareholder current account, do look at it. If company is running as a normal operating, then you don't need to worry about it. You know, it's okay. Yeah.